Good afternoon, almost good evening, everyone. Thanks for spending time listening to me on quite a cold, quite wet day outside. So maybe if I start off just by briefly outlining what an investment trust actually is. So for those of you, not so familiar, so an investment trust essentially is an investment vehicle whereby you can own shares in a permanent capital business, and the capital of that company is used to invest in any particular assets or particular asset class. And for EuroTrust, that means European companies, and specifically those that we regard as high quality businesses. Now, I'll explain later why we do that, why Europe, why high quality, and a bit about our history. But when you think about investment trusts, one of the key advantages for me is that as a fund manager, this enables me to invest with a fixed pool of capital, which means that I can invest for the long term. You're not impacted by inflows and outflows into your fund, and you can really focus on long-term investment. The board oversight is really important. So when you think about yourselves as shareholders in one of these vehicles, it's not just the fund manager choosing which investments he or she would like to make. There is oversight, there is diligent oversight, and there is challenge to the investment decisions provided by the board. And that's something very important. And finally, the use of leverage is also something that investment trusts can do that an open-ended fund structure can't do, or often can't do. So that is something that over time tends to be beneficial to returns. And finally, with EuroTrust, you're buying an investment vehicle, you're buying an investment trust with a multi-decade experience of doing the same thing. We've been doing this for a long time and doing it successfully. So maybe if we flick onto the first slide, and I'll go through why I think now is a good time to be considering Europe. So maybe just the next slide, so slide 10. So thinking about at a very, very basic level, the last 10, 15 years has all been about US. It's all been about US equities. That's where the excitement has lay. It's all been about, in particular, tech companies. That's really driven a lot of interest from investors. It's driven valuations of those businesses up to very high levels, and Europe really has been left behind. And slightly complex chart, but you can see it on here, that if we look at the US, which is the second in from the left, and Europe ex UK, which is third in from the left, you can see if you focus on that orange ball on each chart, you can see that for Europe, we're trading towards the lower end of our historic levels that we've traded at in terms of the valuation of the overall market. So how expensive, how cheap is the market? Well, versus history, Europe is pretty cheap. And then when we look at the US, that orange ball has gone way through the top end. So again, if we're looking versus our own history, the US, is it cheap or expensive versus history? It's more than it's more than even the historic normal range in terms of valuation. It is expensive versus history. So that's the very first point I'd make, is that looking back over history, Europe looks pretty good value. The other point on this slide I'd make is that Europe has tended historically to work better in an environment where there is a bit of inflation in the system, where there's interest rates that, let's say, aren't zero. So it's actually been a tough environment for Europe, as rates have been very low over the last 5 to 10 years, but rates have kicked up, and we'll look at that later. But that's something that generally is a little bit better for Europe. Final point to make, let's compare the US and Europe here. US tech, it's all been driven recently by a lot of excitement around AI. I think to a certain extent, very justified excitement. And this is something that I think is a very, very big theme that will be played out over multiple decades. But I think that's the point. It will be played out over multiple decades, and some of the valuations of these things have moved as if it's being played out over today. So we've got some fairly fully valued tech companies there. And in Europe, one of the things people a few years ago were quite excited by was the rise of sustainable investing and how that might impact a market where there's lots of companies and lots of management teams that really care about sustainability, and that's Europe. That bubble has really burst, over the last 18 months, let's say. So Europe has a really good chance, I think, to start from low valuation and perform quite well, and the US is probably the opposite. So enough about the macro. Let's switch to why quality, because as I said earlier, what do we do for EuroTrust? Well, we buy European companies, but specifically we buy high quality, or those companies that we think are high quality. And I'll show you a slide now that shows you why we do that. So if we flick to the next one, please. So you can kind of ignore most of the detail. I'll talk around what this slide is trying to tell us here. When I think about how I invest, when I look at a business, when I first analyze a company, the very first thing I consider is this a good business? So quality is always the first point of my analysis. Valuation will come second. And that's an important distinction. You know, I'm not attracted by, at first glance, very cheap companies. I'm always attracted by those that I think are very good quality, and then I will look for reasonable valuations to invest in those businesses. So quality comes first. Is this a good business? What I've tried to show here is the explanation for that. So what you can see is I've tried to illustrate two separate notional companies. All the blue lines on the chart and the blue boxes refer to a low quality company, which I've defined as a business that's generating a return on equity of 5%. So a pretty, below average return that you'd expect from a business. Incidentally, just to make sure I'm not, using definitions that are undefined, return on equity would be the profit that a company generates from the assets, from the net assets that it has. So it's just a demonstration of whether a company can squeeze out a high amount of profit from its assets or a low amount. Obviously, you want to invest in those businesses that can squeeze out a lot of profit from their assets rather than a small amount. So the low quality business in the blue lines is a 5% return on equity business, and the high quality business in the kind of orangey red lines is a 20% return on equity business. And as you can see here, the value of compounding with the high return business is crucial, and it makes the starting valuation of that business far less important than you would envisage if you are right on two things. One, that the company genuinely does have a high return on equity business that can be sustainably high return. And that is really important. So it's not just a high return business today, but that continues tomorrow, next year, the year after, etc. And the second thing that you've got to do is you've got to invest in that business for the long term. So the power of compounding only really is, takes hold if you own something for a long period of time. So what you can see here is that with the quality business, and if you go to the kind of chart, the bits below the chart, essentially, what I've shown is that even if you buy a business at 25 times earnings, so on the left-hand side, if this is a high-quality business generating a 20% return on equity, then even if that derates, so the valuation becomes a lot cheaper and ends up being 15 times, at the end of the 10-year period, you're still making a very good compound annual growth rate by owning that share, that business, 14% in that occasion. If there's a smaller fall in valuation, obviously your growth's better. And if the valuation doesn't change at all, then you get a fantastic compounding investment over that time. With the lower quality business that you can see below that, you really need a substantial re-rating for this to be anywhere near a good investment. So what do is I focus on trying to find those quality businesses, and I avoid those lower quality businesses. Now, it's not easy. We don't always get it right, but that's what we try to do. And that is why we will always choose the quality of the business as the most important factor behind an investment decision rather than the valuation. Quality is more important in our view. So we'll move on to another slide now showing a few details on why EuroTrust, and I'll run through these relatively quickly. So first of all, and most importantly, we've been around for multiple decades. I've shown you here the performance of the last decade, and performance has been strong. So numbers are good. You can see that obviously we've had a trickier period over 3 years. I'll explain that later actually in a macro slide. But 5-year numbers very good, and 10-year and beyond that. So we've done the same thing for a long period of time, and we've performed well doing it, and we'll continue to do that same thing. So we'll continue to invest and behave in the same way as we have done historically. Now, what's driven that performance? Well, it's all been about individual companies. It's not been about style. It's not been about sector allocation, choosing different sectors. It's all been about our investments in individual businesses. That has driven our performance. And if we flick onto the next slide, I'll show that. Again, far too many numbers on this slide, so we'll just cut to the chase on it. what this shows is if you look at, this is our attributions, this is the breakdown of our performance over the last year. And you can see on the right-hand side the major drivers of that performance. So the column 3 to the right is sector allocation. That shows whether we have made the right sector decisions. So whether we have got the, an overweight or underweight exposure to each sector and whether that's added value or detracted value. The next column shows stock selection effect, which is the impact of our company level decisions. Have we picked the right business in each sector? And then total effect on the right is the two added together. So ignore the numbers in the table, but skip right down to the bottom row. And what you can see there is that over the last year, very little of our performance has got anything to do with sector allocation. We do not pick sectors in the market. We're not making big calls on whether we want to own energy companies or whether we want to own consumer staples or healthcare or financials. But all of our performance is driven by that stock selection column. And you can see there the evidence of that. That stock selection effect at the bottom row accounts for a high proportion of our returns. So our performance over the long term has been good. And it has been good driven by the individual companies that we own. So I thought now maybe might be right just to highlight a few of the businesses we own, some of which we bought fairly recently, some of which we've owned for a long time. So if we flick onto the next slide, I'll talk a little bit about the actual companies that we own. What is in EuroTrust? If you buy shares in EuroTrust, what are you actually buying? So this is a little flavor. These are 5 companies. We own around 40. But each of these, in my opinion, gives a good explanation for, or a good evidence, really, of that approach I was telling you about, buying European companies that are high quality, high return on equity businesses. So the first I'll choose is Hermes. This is a business that we've owned in EuroTrust since 2013. So we've owned it for 10 years. And over that time, the business has compounded very, very nicely. Hermes, in our view, is the best luxury goods company in the world. It is the one with the most long-standing heritage. The brand itself has over 100-year history. The pricing power that comes with it, that accumulated investment over that 100 years period is extremely strong. To be almost flippant about it, if you're a company that can make a handbag for X units and then sell it for 5X, sell it for 5 times the cost of making it, you by definition have pricing power. You're a business that is positioned in a way that people are willing to buy your products for far more than it costs to make them. That is something that is very, very hard to get in a company, that level of pricing power. And Hermes is a great example of why it is through long-standing focus and investment that you reach that level over a long period of time. Very difficult business to challenge. So that's Hermes that we've owned for 10 years. Moving on to one of our short-term investments, or something that we've owned for far less time, Heineken. So we like the brewing industry in general. It's an industry that scale is very important. Local scale is very important. And it's a business that an industry that over the last 10, 15 years has consolidated dramatically. So there used to be lots of regional brewers. There's now a very small handful of global brewers. This creates an environment where the companies behave in a disciplined way, where pricing is pretty strong. And in our view, Heineken is not only one of the biggest brewers in the world, but has the best, most global premium brand in the world. And with Heineken itself, with the brand Heineken itself. They've got very attractive EM exposures, so lots of emerging markets where beer consumption is growing quite a bit. And it's a strong, high margin business, again, to repeat that point from earlier, with a high return on equity structure. They have high margin, they have some degree of pricing power, they operate in a consolidated market, and there's decent growth. Now, the interesting thing about Heineken for us is the opportunity created by some of the issues they've had. So this year, they've had issues in some of their key markets. So Vietnam and Nigeria, 2 markets that have caused them some issues, but big markets for them, and those markets will come back again in the future. So Heineken, another example of the kind of businesses we like to own here. Hopefully, you're getting a flavour of the kind of companies, the quality of the businesses we like. And then just to maybe touch on SGS. SGS is a Swiss testing company. Now, at first glance, that's not perhaps the most interesting business in the world, but what they do is provide a small but essential function for a company. So any company that is exporting or importing anything globally these days has to adhere to a number of regulatory standards and quality assurance metrics. And they need third-party verification to ensure that they are meeting those metrics. That's where SGS come in. So they test products and test new installations and things like that. In the world we live in, testing intensity is increasing a lot, driven by regulation. That provides the growth. And again, as with Hermes, as with Heineken, there are not that many businesses that do what they do. So it's a globally powerful business with few competitors, has pricing power, growth, and has high returns. I'll be very brief on the other two, just in the interest of time, but ASM is a semiconductor equipment business that we bought about a year ago. I mean, this is a tech company in Europe, which may surprise some people. You know, you hear so much about the quality of the US tech businesses and the fact that there's no good quality tech companies in Europe. Well, there is. And semiconductor equipment is one of those areas where there are some brilliant businesses. And ASM for us is best in class. It is market leader in a technology called atomic layer deposition that is crucial in advanced semiconductor manufacture. They have high market shares, they've got pricing power, strong gross margins above 60%, and strong return on capital business. And then finally, just very briefly on Safran, this is an engine, airplane engine company. The beauty of this model is not in the selling of engines, but in the selling of the aftermarket services that comes when you sell an engine. So let's flick on. Those are some of the companies we own. If we go to the next slide, I'll talk a little bit about why now. So one of the things over the last 3 years has been that, as we all know, inflation has returned with a vengeance. You know, inflation's run at levels far higher than historic norms, and we've seen one of the fastest tightening cycles in history from both looking at it from a US perspective and a European perspective as well. So extremely tight. Or a very rapid tightening in monetary conditions. What that has resulted in is inflation starting to moderate and approach much more normal levels, both in Europe again and in the US, where we're now talking about inflation or underlying inflation in a kind of 3% range. Whereas a year and a half ago, we're talking about it in 7 or 8% range. So there's been a very, very big change very quickly, and with that, economic conditions have moderated. Now, these conditions that we've seen of rates going up, inflation being high, and economic conditions being fairly robust has led to an environment where the kinds of businesses that I like to own, so those higher quality, long-term minded, high return on equity businesses, have underperformed some more cyclically exposed, what people might call value companies. So less expensive, lower quality. And that's been the environment the last 3 years. So when I think about why would you want to invest in EuroTrust now, it is because of some of the actions that we have taken in that environment over the last 3 years. So what have we done? We've used the weakness in the share prices of some of these high quality businesses to buy more of them and to initiate new positions in some companies that are, in our view, extremely high quality, but were being sold off by the market in a tough environment for quality. So if we look at the next slide, we can see some of this in action. So again, not much need to go into too much detail on this, but this shows portfolio level characteristics of a EuroTrust as a whole over the last few years. And the key thing to focus on is that black line and that orange line, where you can see that we have always been biased towards high return on equity and high operating margin businesses, but from about mid-2021 onwards, you can see that bias increased, and that was because we were buying more of those types of businesses. So people say that every cloud has its silver lining. The cloud of a tricky 3 years, admittedly, for performance, has been better recently, but a tricky 3 years for performance, the silver lining to that is we get to buy more of the same things, more of the things we want to buy and own at more attractive valuations. So that's what we've been up to, and that for me is answers the question on why now. So if we move on to the final slide I've got here, and then we'll take some questions if there are any. But the final slide is all about kind of some of the themes, and we haven't got the time to go through these in a huge amount of detail, but just some things maybe for you to think about, and some of the things that I'm thinking about when I think about this portfolio and I think about 2024. So firstly, obesity. Slightly strange thing to start on, but 2023 has been the year when obesity medication has really hit the mainstream. Our largest position is a company called Novo Nordisk, which manufactures something called Ozempic, which you will have read about, and they also have a brand called Wegovy, but they sell weight loss medication. The shares have been absolutely stellar, up 40% this year. And those companies that are deemed to be negatively impacted by this rising use of obesity medication have been treated very, very badly by the market. Some food producers, for example, if you make snacks or junk food, then the market has assumed that you might have less demand if there's going to be high proportions of the population on obesity medication. 2024 for me is a year when the impacts of this on the stock market become a bit more nuanced. So I think that there's been a bit of an overreaction in certain areas, and I think we will have a lot more to say about this as the year goes on. But my view is that the food producers in particular have been treated overly harshly, and the impact won't be quite as much as people think. But that's something to really watch out for when you think about your investments and how you're positioned going into next year. Stock level dispersion is something that's really picked up. This is good for us. We're stock pickers. We like this. But you only have to look at, the pharma sector as a good example that we've just touched on. Novo Nordisk up 40% year to date. AstraZeneca, another large cap pharma company in the UK, is down, I think, about 7 or 8% year to date. Bayer, a German pharma company, down 35%. Huge dispersion in a very defensive or traditionally very defensive sector. So that's a good thing. The pickup in stock level dispersion is something we're excited about. And then maybe just a couple of things to finish on. The semiconductor cycle, that is something that excites us. We bought into the semiconductor sector at the end of last year. We believe that the sector, in terms of the operating conditions, bottomed somewhere midway through this year. We wanted to buy ahead of that. It's a very cyclical business, and we believe that 2024 will be another year of upswing in the sector. And to add to that, there is the trend of AI. AI needs compute. It needs data centers, and all of those themes play very nicely for the semiconductor sector. So we're spending a lot of time thinking about our positioning there and quite excited by prospects. And the final point to leave you on is, where is the ESG bubble gone? If we think a few years ago, it was almost all we were talking about was sustainable investing, and yet. And that was a big theme in Europe, and there's a lot of exposures in Europe to that theme. That's really unwound. And for me, I look at that as an opportunity to buy some of these businesses. So over the next 12 to 18 months, that's something I'll be spending my time doing, is trying to find some of those former darlings, some really well-positioned, highly sustainable businesses, maybe those involved in renewable energy, for example, that are sold off very aggressively during 2023. So those are some of the things I'm thinking about. Happy to leave it on that note. Thank you very much all for listening. And if there's any questions, more than happy to take them.
Thanks very much, Jamie. A very interesting presentation. Much appreciate that. So we've got a couple of questions so far. So the first one from James. You mentioned that Europe does better than the US when interest rates are higher. Why is that?
The first thing I'll say on this is that is obviously quite a general statement. And history, doesn't always prove to repeat. However, in the past, what we've noticed is that if you have a cyclical business, one that is responsive to economic conditions, generally increasing rates is associated with a fairly buoyant economic environment, unless you're in some horrible catastrophic environment. But generally, when the economy is getting better, rates are going up. That cyclical business will likely do better in that environment. And so the share price of that business would likely to go up. So there is a correlation between rates going up and cyclicality doing well, cyclical businesses doing well. And Europe, when we compare it to the US, or we compare it to some other markets, has a higher proportion of those cyclical businesses, mostly through the exposure to industrials, through less exposure to tech than the US, which tends to be a bit more of a, especially in software, a bit more of a defensive area. And also our exposure in Europe to things like commodities, things like energy, and the value chains of those businesses. So that is why it's a more cyclical market.
Right, thank you. And then Tom is asking, what are your views on smaller European companies? The ones you've mentioned are all large cap businesses in Europe.
Yeah, without wanting to kind of sidestep a question, I think this is, so EuroTrust historically has really only invested in mid and large cap. Now we have the ability to invest across the market cap spectrum, but we have a very credible, capable, smaller companies franchise here that do that, and there's an investment trust there that operates in that space, run by Ollie Beckett. So that's something that really we leave for them. We tend to be operating in the mid and large cap area of the market. So yeah, no strong view just because it's not the area of the market I look at.
Mm-hmm. Thanks very much. So those were the questions that came from the audience. A general issue for the investment trust sector this year is that discounts have tended to be at very elevated levels. How has the discount been on the EuroTrust, and what are your views on that issue?
So if I look at the European landscape, so if I compare my investment trust and the other European investment trust versus history, historically, generally they've traded at between parity, so the share price equaling NAV, and somewhere in a 10 to 15% discount range. So anywhere in that range is where they've traded. At the moment, we're right at the bottom end of that range. So discounts, I would certainly agree with your view there that discounts have widened. Does it matter? Well, in extreme, it matters. Because, if you're trading at a 50% discount, let's say, then there is a strong argument for that structure not working and for there to be a better solution, i.e. some sort of corporate action resulting in that investment trust no longer existing. At the levels of discount we're at, that's not something that I think is realistic. However, we want our shareholders to see the best returns over time. And so it is suboptimal for our shareholders to be owning a vehicle that is trading at a 15% discount to the underlying value of the assets they own. So what do we do about that? There's several things we could do. We could buy back shares. That is an option that some trusts take. It's not something that we've done. And we haven't done it because liquidity is also something that's important for our shareholders. And we're not a massive investment trust. And so we would prefer not to reduce the share count and make ourselves even less liquid. So that's one potential option. The other one is for me to get out there, explain the message and drum up interest and make sure that people see the potential from this investment trust, from investing in quality businesses in Europe, and get people interested. And that is also over the long term, in our view, the best way for us to manage the discount, me to perform well, and me to ensure that that EuroTrust gets the best kind of visibility as possible.
Yes, thanks, James. It's been a difficult issue this year. I mean, one of the factors that has been reported quite widely in the media are the current cost disclosure requirements that they've resulted in an element of double counting, which has prevented some wealth managers from including trusts in their portfolios. Have you experienced that?
No, it's not something we've experienced. I can, again, I probably read the same press that you read, and I can see that concern. But we believe that we've been, very, very transparent with, where the costs are, and obviously disclosed. And we do get questions about it at the AGM, as we should do. Where are we spending money? Where are the costs running on the trust? But we keep things, to as low a level as possible and disclose it appropriately. So no, not something that we've seen as an issue. I really think, in a way, when discounts are wide, everyone wants to look for a reason, wants to understand why, and sometimes it can be as simple as the appetite for Europe at the moment, for whatever reason, just isn't there. And whether that is because there is the too much interest in some of these US tech companies that are changing the world with AI, and maybe the interest lies there. But over the long term, the discounts have been in that kind of 0 to 15% range. I assume they'll remain in that range, and hopefully they'll narrow rather than widen from here.
Yes. Can I just remind the delegates, if you have any questions, please do click the Q&A button and type them into the box. Certainly been my experience that buying investment trusts when discounts are wide is quite a good strategy, because they do tend to revert to the mean over time. We have a question come in from Richard. How would you say that EuroTrust differs from HEFT? I see that there's a degree of commonality in the holdings at times.
Yeah. So just for those that don't know, HEFT is Henderson European Focus Trust, which is managed by Tom O'Hara, who sits about 2 meters that way. So he's very, very close to me on the desk. What I would say is that if you looked at EuroTrust over time and you looked at HEFT over time, what you would see is that EuroTrust has always tended to be in what I would describe as the top half of the quality spectrum. So when I look at a business, almost every business I own, one of the predominant factors has to be, is this a better than average quality business? That's almost question one. And so that means that we have that bias to quality. I showed those slides on return on equity and operating margins. We tend to have higher statistics than the market. So that is a key feature of EuroTrust over a 20, 30-year period. When I look at HEFT, however, they have a far more open-minded approach to the quality of the business that they invest in. Clearly, we're both trying to do the same thing. We're both trying to produce the best returns for our shareholders over time, but they do in a slightly different way and a much more kind of open-minded way as to the quality of the business. So in simple terms, I sometimes describe the style in the market as being a ruler, with one end being deep value and the other end being all-out growth and quality. I'm at the right-hand side of that ruler at all times. HEFT really positions itself anywhere along that ruler, depending on the market conditions they see. So that's the biggest point of difference in how we do things. Having said that, we do have some overlap. I think at the moment there's 16 companies actually. So 16 of the 43 companies I own, they also own. So there is overlap, and there has been overlap historically. We tend to perform well in different markets to each other, but we do sit around a desk together. We do debate stocks together. We do argue and debate over stocks, which is a very healthy kind of environment. So some similarities, some differences, but we believe, enough differences to differentiate between the two.
Great. Yes, it's always good to have some fellow investors to bounce ideas around with and get some feedback on. That's generally helpful. Well, that seems to have wrapped up all the questions from the delegates. So once again, I'll just say thank you very much, Jamie. It was a very interesting presentation, and thanks for answering the questions.
Thanks very much, Mark, and thanks everyone for listening.